The Peter Schiff Show.
This is my first day back here in Puerto Rico. I spent the last several days up in Vancouver, British Columbia at the Cambridge House Resource Conference. Pretty good attendance. I think it was a lot more crowded than it was last year, maybe twice the number of people, lots of people roaming around the exhibit hall. So I think it's a good sign that we're starting to see some interest now. Remember, it was about exactly a year ago that we bottomed out in precious metals, we bottomed out in industrial metals and agriculture, and we've had a huge rally in the commodity complex over the last year. It's continuing this year, and I think this is just the beginning of a huge new bull market in these sectors. And speaking about bull markets, the stock market, not only did we trade above 20,000, finally today, the first time after flirting with it for so long, we finally not only got above 20,000, but we closed above 20,000. In fact, Donald Trump is so excited that the Dow's at 20,000 that he actually tweeted out a comment. He tweeted out a United AP press story. The story says Dow Jones Industrial Average trades over 20,000 for the first time. Latest milestone in record-setting drive. To which Donald Trump, president of these United States, tweets out, "Great, Dow 20K." Now, if the Dow had crossed 20,000 during the campaign, during the election cycle, before he was president, he would have said, big bubble, big fat ugly bubble, look out, this is a phony market, it's propped up, it's going to come down when interest rates go up, this is going to get ugly, don't believe the Dow. And he would have been criticizing the Dow. Now he loves it, it's great, right? This is huge, this is incredible, he's taking credit for it. Hey, the Dow is at 2,000 because of me, I'm president, things are good, right? It's a bubble. If it was a big fat ugly bubble when it was Barack Obama's bubble, now that it's Donald Trump's bubble, it doesn't change the characteristics, the nature. It's still a bubble. If it was a bubble then, it's a bubble now. Now, if Donald Trump no longer thinks the stock market is a bubble, well, was he just lying when he was campaigning? Was he just calling it a bubble because it was politically expedient, but it was really a bull market? You know, I guess a bubble is in the eye of the beholder, right? When it's your bubble, it's a bull market. When it's somebody else's bubble, well, then it's a bubble. Well, if it walks like a bubble, talks like a bubble, quacks like a bubble, it is a bubble, and the big fat ugly bubble is bigger, fatter, and uglier now than ever before. In fact, Trump, when he talked about the stock market bubble as a candidate, said, when interest rates go up, that's going to be a problem. Interest rates are going up. And I'm not just talking about the rate hike that we got from the Fed in December last year, and maybe we'll get another rate hike by the Fed, maybe we won't. But I think regardless of what the Fed does, the market is going to push rates higher. Certainly long-term rates are going to go up, and corporate rates are going to go up. Corporations that have been borrowing money on the cheap for years, the cost to corporations to borrow money is going to go up, right? Right now, quantitative easing, even if the Fed goes back for QE, they're not buying corporate bonds, they're not buying junk bonds, right? They're not even buying muni bonds. So I think across the spectrum, we are going to see higher interest rates. And interesting enough, not only was the bond market very weak today, but so was the dollar, right? Bonds got clobbered and the dollar got clobbered. We haven't been seeing those two move in tandem for a while. They've mainly been doing the opposite, right? On days where the bonds were up, then the dollar was down. And when bonds were down, the dollar was up. Today, both the dollar and bonds went down at the same time. Now, this is what I think is going to happen. This is going to be the new paradigm. The only thing that didn't join the party today was gold. And I've noticed recently that gold tends to go up when the stock market is going down. And so today, I think that 20,000 milestone for the Dow sent gold down about $10 or so, but we still managed to close right about 1,200, just above 1,200. But the dollar index trading below 100, it closed at 99.92. I think was the last trade. I think this is the lowest close for the year on the U.S. dollar index. Big moves up. The big mover today was the Canadian dollar. And I think I mentioned that head fake move in the Canadian dollar last week when the Canadian Central Bank hinted about a rate cut possibility, and that sent the Canadian dollar down. And I said, hey, it's a great buying opportunity for Canadian dollar. We had a huge rally yesterday in the Canadian dollar, and another big rally today, up over 1.5% in Canada in the last 2 days. We're right near the highest levels of the year in the Canadian dollar. In fact, we're near the highest levels of maybe a couple of years. Really, you have to go back. Well, I say we've been higher in early 2015. I mean, we've been marginally higher in May of last year, but just a little bit. I mean, it wasn't much significant. I mean, we're well above the low. That currency put in a low in January of 2016, just when gold put in a low and just when oil put in a low. That currency very sensitive to commodities. The Australian dollar has been trading even firmer than the Canadian dollar, but the Australian dollar also bottomed out in January of 2016. So commodities bottomed, commodity currencies bottomed, and this is a whole new dynamic. And those people who were so bullish on the Dow, the Dow is above 20,000, but it is very expensive on a PE basis. But a lot is changing, and these changes are not fundamentally good for the stock market. Think about what has been propping up both the U.S. economy and the stock market over not only the last 8 years under Barack Obama, but really for a lot longer than that. It's been artificially low interest rates and cheap foreign imports. That's what's been keeping the consumer going. He can go out and borrow money cheap. He can refinance his mortgage. He can get his mortgage payments down. He can go out and buy a car with 0% financing, right? Low interest rates. Low interest rates also meant that asset prices were going up. You had the wealth effect. When it comes to houses, you can extract the equity, right? You could do refinancing. If you have a stock portfolio, you can margin it, you can lever up your portfolio, or you can sell some of your appreciated stocks and spend the capital gains. Generally, you were selling it to somebody else who was levering up to buy it. So if it wasn't for the cheap money, you wouldn't have the person to buy the stock that you wanted to sell. So Americans have been living off of inflated asset prices. They've been living off of cheap credit. They've been living off of cheap imports, right? Americans haven't had real earnings growth, but we can keep buying things because we keep importing stuff from other countries, right? We don't produce it, but we can import it cheap. So it's cheap imports that are helping the consumer temporarily. It's a cheap mortgage. It's inflated asset prices. And the same thing with corporate America. What's been driving the stock market? Well, one thing has been outsourcing, right? Companies laying off American workers, shutting down expensive capacity in the United States, opening up offices or contracting, outsourcing in other countries, reducing their costs. Companies have been growing their earnings by outsourcing, right? They've been keeping their costs down. That's helped the stock market because it's lowering your costs. It also keeps consumer prices down, but it also keeps profits up of U.S. companies. Also, what's been driving the stock market? Share buybacks. Where does that come from? Debt issuance, cheap money, artificially low interest rates allows corporations to borrow a lot of money and then buy back stock. And of course, during the era of plentiful cheap money, we've had a bull market in bonds, right? Financial assets have been gaining in value, bond prices rising. That helps the stock market. And of course, as interest rates go down, more people want to buy stocks because there's less yield in owning bonds. So people go for dividend-paying stocks. Stock market valuations are higher. The lower the interest rate is, the higher the present value of the earnings from that company. So everything's been a function of cheap money or cheap foreign imports. All of that is coming to an end, whether it comes to an end naturally or because we bring it on ourselves as a result of policy coming out of the Trump administration. What does Trump want to do? Well, first of all, he wants us to hire America and buy America. That means no more outsourcing. That means corporations will not be able to drive their earnings by driving their production offshore. If anything, he's trying to encourage them to bring back some of the production domestically, which is going to mean it's going to be more expensive. Even if we succeed in rolling back some regulation, it's not going to be enough to make the U.S. domestic production more competitive than the global production. I mean, that's why companies left the U.S. in the first place. And it's not going to be enough as far as just some deregulation to the extent that we actually get it. I don't think that in and of itself is going to be enough to tip the balance in favor of domestic production. The other thing that's going to happen is maybe there'll be some tariffs. Maybe there'll be a border tax, a border reduction tax, or a tariff, which automatically makes imports more expensive. And a lot of companies, even if they manufacture here, they import their components, the parts, the raw materials. And if all that stuff is more expensive, it's going to diminish corporate profits, and it's going to force corporations to raise prices. So now you're going to have falling profits, and you're going to have rising prices. And what's going to happen to the bond market? Bond market's going down. If we're going to have higher inflation, which we're getting, and look at commodity prices. Look at, I think zinc prices are up something like 80% in the last year. Look, all these industrial metal prices are going up. Energy prices are going up. Agriculture is going up. And this is just the beginning. And as the dollar starts to go down, and we're flirting with a new bear market in the dollar. We're going to have new bear market in bonds. So now we're going to have rising inflation, and we're going to have a falling dollar, and that is not the environment that's conducive for U.S. stocks, right? The U.S. stock market did good when we had falling inflation and a bull market in bonds, falling interest rates, and the American consumer could rely on cheap money and cheap imports. Well, those pillars, right? Those pillars of this bubble economy are going away. Imports aren't going to be so cheap anymore. They're going to be more expensive. Interest rates are going to go up. Your home mortgage is going to get more expensive. Those cheap 0% financing for automobiles, that's going away. All of this dynamic is changing. And so if we're now going to have a bear market in bonds, a bear market in dollar, rising inflation, rising interest rates, what's going to work? Commodities are going to work. Gold is going to work. Emerging markets are going to work. Foreign stocks are going to work, right? And that's why they are working. I mean, last year was the beginning, right? Most people don't realize how the U.S. market underperformed last year because they just focus on the big spike at the end of the year and the fact that Dow's at 2,000. But even with that spike, the U.S. underperformed. And this was the first time in many years that was the case because the U.S. was the only game in town for many, many years. And that's despite the fact that the dollar did hit a new high in the post-Trump election. But it has been surrendering those gains all year. We're still a little bit above the level we were at the day after Trump won, but I think it's only a matter of time until we take that out. And the question is, how much longer will the stock market be able to ignore the negative fundamentals for the stock market? Because rising interest rates, rising inflation, ultimately falling profits, and then higher discount rates are going to be negative for stocks. Now, I know there are people that are thinking, well, but we're going to have corporate tax cuts. Yes, Trump is talking about maybe a 15% corporate tax or a 20% tax. I'm really not sure what the number is. But, that's about what corporations pay right now anyway. And so for a lot of companies, they're not actually going to get a tax cut. I mean, taxes might be simpler and it might be fairer. So some companies might see their taxes cut. Others might see it increase. But overall, it's not necessarily a tax reduction for the S&P 500. Meanwhile, if their earnings are going to get squeezed by rising costs because of a weaker dollar or because of tariffs or because they have to produce more domestically, or interest rates start to go up and their debt service cost goes up, there's going to be a lot of factors weighing down profits. So even if profits go down, even if taxes go down, the taxes will be on a lower amount of profits. And of course, if companies end up with losses, if interest rates rise to the degree, if their import costs rise to the point where they now have losses, then what difference does it make if they have a tax cut? Because tax cuts don't benefit you if you have no income to tax. You have to have income. So if your company is operating at a loss, the fact that you have a lower tax rate isn't going to matter. And that might end up being the case for a lot of companies that are going to have a hard time making a profit in a rising cost, rising inflation, rising interest rate environment. That's the environment into which we're headed. A lot of people also, I see, comments on some of these video blogs or Facebook, I got to give Trump a chance. I got to see what he's going to do. Look, I voted for him, and I talked about that when he was a candidate as to why I thought he would be better to have as a president than Hillary Clinton. But I am not, so Pollyannic to believe that just because Donald Trump is president, that all these problems are going to magically go away. I know they can't magically go away. I know there's only one way to make them go away, and it's going to involve the Dow Jones going down, not up. The Dow going up means that we're getting further away from solving the problem because interest rates have to go way up. That's the only way we're going to solve these problems because we have to have legitimate savings. We can't just have the central banks creating money. And in order to have legitimate savings, we're going to have Americans to stop spending, and we're going to have to deflate these asset bubbles. And I know to have real meaningful tax relief, it's only possible if we have dramatic cuts in government spending, and we're not going to get that. I mean, yes, Donald Trump is talking about cutting some spending. Maybe he'll succeed in those discretionary areas. Maybe he won't. I don't know. But he's also talking about increasing spending in other areas. And it's far more likely that he'll get the spending increases than the spending cuts. Because the Democrats, of course, are going to back whatever he wants to do when it comes to spending increases. It's just, they're not going to get behind the cuts. And on the Republicans, it's probably going to be easier to find Republicans who want to spend more than Republicans who want to take a gamble and actually cut something because they're more worried about getting reelected. So it's not about I'm not giving him a chance. I understand the real nature of this problem. And to me, the attitude that Trump has and that he's had since he's been elected is that he doesn't want the bubble to pop. That's why he's not calling it a bubble anymore. He's not preparing people for the tough love. He's not talking about how government is going to have to reduce benefits, right? That people are not going to get what they've been promised. He's promising that everything's going to get better, right? We're just going to keep on winning and winning and winning, right? That it's just now that he's elected, everything bad is going to be good. All of a sudden, we're going to have real jobs. We're going to have rising income. The economy is going to grow 4% a year, 5% a year. That's impossible. It can't, not on this phony foundation. We can't build that kind of economy on this foundation. We have to let this foundation collapse, and we have to rebuild a real one. And we're not taking any of those steps. Trump is not preparing people for those steps. Now, I know there's a school of thought out there. People think, look, we don't actually need real savings, right? We can just create money. The deficits don't matter because, we can just keep printing money, and it doesn't matter. We could just keep borrowing because we're never going to have to default, right? Because as long as we're borrowing in our own currency, well, we can always print it. There's nothing that stops the Federal Reserve from printing money, so we can have as much debt as we want, and we never have to default. And I guess in theory, that's true if you're willing to completely destroy your currency. Because if the markets believe that that is what you are going to do, right, that you're never going to pay off your debts, you're never going to reduce your debts, that you are going to just print forever, then you will have a currency crisis. And the only way to stop the currency from becoming worthless would be to massively jack up interest rates in a huge, huge way. And then you're going to just have devastation. The idea that we can, borrow indefinitely in our own currency without destroying the value of that currency. See, that is the problem. And that's the reason that you want to get the deficit under control before our creditors figure out that this is our end game, right? That's the reason you want to avoid the potential of hyperinflation. So you have to act responsibly. You have to reduce the debt or balance the budget now. You can't just take the attitude that we never have to do it. We don't have to worry. And the people who are worried about deficits don't understand that we could print money. They do understand that we could print money. That is the problem. That will be the death of our currency. We will print it into oblivion. And the reality is what's really holding up the dollar now is people don't think we're going to print it into oblivion. They think we're going to get our deficits under control. They think we're going to cut spending. I don't know why. I don't know why anybody would think that any U.S. politician is going to act responsibly if they don't have to. It's only the crisis, when they have no other choice, when all the other politically expedient options are exhausted, that's when they do the right thing. And even though Trump is a different president, maybe, it's the same Congress, right? These guys have been there before, right? And, they know how the game is played. And I think now that Trump is there, he becomes part of the game, just like Ronald Reagan. I mean, Ronald Reagan probably wanted to cut government more than Donald Trump, for sure. He did. And he didn't. Government grew and grew and grew. Now, you can argue, well, he had Tip O'Neill. Well, who knows? Maybe if Tip wasn't there, maybe, even if the Republicans controlled the House, it would have been the same thing. Because you got other examples where Republicans had both houses of Congress and government spending grew. So we'll see what happens. But most of it now is on autopilot anyway. Nobody wants to cut it. So you can't just keep borrowing forever. And of course, real savings just can't be manufactured out of thin air by government. We don't want the government to try to replace legitimate savings, because in order to have real economic growth financed by real savings, you have to have underconsumption. That's how the resources get freed up. Just because government can pretend that it's creating savings by just manufacturing out of thin air with a stroke of a pen doesn't mean it's legitimate. And what's happening to the economy is you're getting malinvestments. You're sending false economic signals to the economy. You're misallocating resources. You're creating bubbles. This kind of government, funny money engineered out of thin air doesn't replace legitimate savings. Legitimate savings leads to real sustainable economic growth and rising living standards. When you try to replace actual underconsumption with a printing press where nobody sacrifices, nobody saves, and the government just creates money, all you have is inflation. And in the short run, inflation can feel good. What's that, that analogy that Warren Buffett made about peeing in your bed, right? He says, you could pee in bed, and initially for maybe a few seconds, right, it feels good, right? Maybe it's like a relief, right? Oh yeah, but then as soon as you realize, that you just, soiled your sheets, now you have a complete mess that you have to deal with. Despite the fact that for a few minutes it felt good, it would have been better just to get out of bed and go to the bathroom and not have to deal with the mess. And of course, that's the same situation here. Yes, inflation can feel good until you have to deal with a mess. And it feels good when the stock market's going up and the real estate market is going up, and it seems like everything is here for free until the bubble burst. And the bubble burst in a big way in 2008, but you know what? We ain't seen nothing yet. That was just a small tremor, unfortunately, because we didn't allow the restructuring to continue. We interrupted it with this massive bubble that we now have that belongs to Donald Trump. Right, this is now Donald Trump's bubble, and I wish, as I said before, he would still call it a bubble, because he needs to put the blame on Obama. He needs to put the blame on the Fed. But by tweeting out that this is great, by embracing the stock market, he owns it. Now if it goes down, it's his fault. Now if it pops, it's not a bubble, it's, oh, what did you do to ruin this great bull market? The left, the media, is ready to pounce on Donald Trump when something goes wrong, right? The stock market goes down, they're going to blame it on him, so he should be out in front. He should be saying, yeah, the stock market is going to go down because it's overpriced. It's too expensive. That's part of the solution. That's part of making America great again. We have to have a real stock market, not a bubble. We have to have a real bond market. We have to have a real estate market. We have to have legitimate savings. We have to have real income. People have to spend out of income, not out of debt. We don't want consumers going into debt. We don't want them borrowing money to buy things they can't afford. We want them saving money. But this transition, right, is not going to be very pleasant based on the experience of the past. But he is not doing that. He is not saying that. Now we get our first look at fourth quarter GDP on Friday. And I think the consensus is for about 2.2% GDP growth. That's quite a bit lower than the 3.5% that we got in the third quarter. If you remember earlier in the year, I was saying that I thought the third quarter would be the best quarter of the year, and it was, although I did expect the numbers to be quite a bit lower than they ended up being. And again, a lot of this, I think, has been pumped up by the fact that the inflation rate, the deflator, has been so low for so long. We'll see if the government continue to work that magic, if they continue to mask the weakness in the economy by understating inflation. So I'm looking at some point, maybe that deflator is going to have to pop up, especially if you consider what's actually going on in the economy if you start to look at prices. But still, 2.2% is still a substantial decline from the third quarter of last year. And I think that the first quarter of this year is going to be another weak number. We're not going to be anywhere close to the 4 or 5% that Donald Trump claims that the economy is going to grow at. Now, of course, whatever the number is, right, if it's a bad number, Donald Trump is not going to accept responsibility for it. If somehow it's a good number, maybe he'll claim credit. But the number that he's going to own is going to be the first quarter of 2017. And I think that number is still going to be a lot lower than the type of number that Donald Trump wants to achieve. And of course, how is he going to try to achieve it? By running up the deficits, by ramming through some tax cuts, moving with some increases in government spending. And that, again, is just going to fuel the trends that I talked about earlier in the podcast of a falling dollar, of rising commodity prices, rising consumer price inflation, which will undermine real incomes, undermine the real economy, and undermine this stock market bubble. Also, I want to finish up with a story that actually just came out as I was recording this podcast. And if anybody is harboring the delusions that Donald Trump is a free market guy, this will prove it. Today, Fannie Mae announced that it is going to guarantee the loans of a private company, Blackstone, which has a company, Invitation Homes, and they own about 50,000 single-family homes that they bought up in the market. The company has a lot of debt on those properties. It has about $9.7 billion in properties at today's phony appraisals, but it has $7.7 billion in debt. And now the government is going to guarantee $1 billion of that $7.7 billion. Now, the government guarantee means that the bonds are going to be considered safer, right? Because they're like treasuries now. And so what that will do is help Blackstone with its valuation. Apparently it's going to be doing a IPO of this company, Invitation Homes. It's going to be selling $1.6 billion worth of stock. And by having the government partnering with them, in a sense, and putting the taxpayers on the hook in case these loans go into foreclosure. And the reason that the taxpayers are being put on the hook is to increase the value of this IPO, to increase the value of this real estate portfolio, and to make it easier for this private hedge fund, this private equity group, to go out and buy real estate, because now it can buy real estate and have it guaranteed by the U.S. government through Fannie Mae. Now, this is a perversion of everything that Fannie Mae is supposed to be about. Not that it was a good idea in the first place, but it was supposed to make homes more affordable for average Americans, not billionaires who own hedge funds who want to buy up houses to rent them out. The government now, U.S. taxpayers, are standing behind the mortgage debt that the wealthy fat cats are taking on in order to buy back houses and then rent them to people who can't afford to buy them. Are we really supposed to be using taxpayer money to make it easier for real estate speculators to buy houses to rent them out to people? I thought Fannie Mae was about making home ownership more affordable, not making it more affordable for wealthy institutions to buy homes to rent them out. So this thing is completely ridiculous. And why should the government get involved? I mean, why should the government guarantee these loans? Why should taxpayers have to bear the risk if these loans go into foreclosure? And of course, all the properties are overpriced. Eventually, prices are going to go down. Eventually, people aren't going to be able to pay enough rent to cover the higher cost of servicing the debt. Eventually, there's going to be a collapse here. And now the taxpayers are going to be on the hook through Fannie Mae. Now, why isn't Donald Trump stopping this? Right? He supposedly, there's a moratorium on new regulations. Well, doesn't that mean, isn't there a moratorium on bad ideas coming out of Fannie Mae? This is very anti-free market. This is about the government working with the private sector. This is fascism, is what this is. And is Donald Trump condoning it? He's not stopping it. It's happening under his presidency, where the taxpayers are being put at risk, so a few wealthy people, right, can make more money on this IPO and to make this portfolio of rental properties more valuable to the owners of the rental property, not to the poor tenants who can't afford to buy houses who are renting it out, but to the very, very wealthy people who own these shares in Blackstone and who are going to be, raking in this 1.6 billion that they're going to raise by going public. And of course, the public is going to buy into this thing at a high valuation, and that high valuation is going to be helped by the government, by Fannie and Freddie, artificially reducing the cost of borrowing to buy houses to rent them out. But this is a terrible thing. It is very anti-free market. It's the opposite of what so many people think that the Donald Trump administration is going to be about. But I tell you, as I said, this is really not going to be the free market. This is going to be government involvement in the market. It is about the government trying to micromanage the economy, only trying to do a better job. You have people in government now who think they're just smarter than the people who used to be in government. And because the people in government now, in theory, believe in the free market, that doesn't mean that they're going to do a good job of trying to dictate from government what should be happening in the market, because then it's not free. If you really believe in the free market, you want to eliminate all this stuff. Right? What would make me so happy is if Donald Trump, instead of coming up with all these smart private sector people to be running these government departments, how about if we just appointed people who specialized in liquidation, specialize in bankruptcy and workouts and winding things down, so that every time we have somebody, like instead of putting Rick Perry in charge of the Department of Energy, which he now loves, which he wanted to eliminate as a candidate, but he now loves it. How about if they put somebody in charge who said, my goal is to wind this department down by the end of the year, so that there's nobody left, no more employees. We're going to figure out how to dismantle this department and figure out how to consolidate some of the functions that may be necessary in other parts of the budget. That's what I want to see. I want to see people that are determined to dismantle these agencies, to downsize government. Yes, Trump does talk about, okay, we want to have a freeze on hiring, or maybe we want to reduce the head count. That's not going to be enough. That's not going to do it. We have to completely eliminate agencies and departments, and that's not happening. And when you see something like this, when you see Fannie Mae getting now into the private market, into the real estate market in a way that it's never done. So far, the only mortgages that Fannie Mae has guaranteed were individuals buying their own homes. Now you've got the government guaranteeing money that a private corporation, right, when a private corporation borrows money to buy a house to own as part of a portfolio, an institutional portfolio, they're going to go out and borrow money to buy a house, and then they're going to take that house and rent it out to American citizens. Now the underlying debt on those rental properties is now guaranteed by the government. And if the government created a disaster by guaranteeing single-family homes for ownership, don't you think it's also going to be a disaster when they're guaranteeing these rental properties? And of course, the homeowners, in many ways, when people owned a home, they had a greater incentive not to just walk away because it was their home. But when you have a rental property, it's a riskier loan. That's why if you go into the rental market now, if you want to go out and borrow money without the government, if you want to go to a bank and borrow money, if you borrow money to buy your primary residence, right, even if it's a jumbo loan, right, so it's not even government guaranteed anymore, right? Just say, let's say you want to borrow a couple $1 million, right, to buy a big house and you're going to live in it, you're going to get a better mortgage rate than if you go out and borrow a couple $1 million to buy a rental property. Right? Because the banks know that, well, if you don't actually live in it, if you're just renting it out, then maybe you're more likely to walk away from it if there's a problem than if it's your primary residence. So these loans could be inherently riskier than the single-family homes. And the fact that Blackstone needs this, the fact that they need a government guarantee, proves that there's a lot of risk in there. Because obviously they were worried about the markets perceiving risk in all this debt. And how do they assuage that risk? How do they reassure the markets who may have rightly been worrying about all that debt in a rising interest rate environment and in an environment where real estate prices have peaked and are probably falling? How do you placate the market? How do you reassure the market not to worry? Get the government to guarantee it. Now there's nothing to worry about. Well, you know who's got to worry? The taxpayers. The taxpayers have to worry. And of course, that means all holders of U.S. currency have to worry, because who's ultimately on the hook if the taxpayers are broke and they can't pay? It's the Federal Reserve that has to print all the money to finance the bailouts. And so everybody pays with a depreciated dollar and a higher cost of living.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro Pacific Bank at europacbank.com. Euro Pacific Capital and Euro Pacific Bank are affiliated companies.
Hi, this is Peter Schiff, and long before foreign governments were buying gold, I urged my clients to put 5 to 10% of their portfolios into physical precious metals. Despite gold's massive rise over the last decade, I still think that a 5 to 10% allocation to gold and silver is a smart investment decision. But buyers have to beware. Big TV gold dealers push all sorts of coins that are poor investments. Bait and switch deals, price protection guarantees, leveraged gold accounts. These are just a few of the sleazy tactics used to swindle inexperienced gold buyers. My gold company is different. We never offer a coin or bar unless I consider it to be a good investment. I want my customers to be educated. That's why I'm offering you a free research report exposing the biggest scams and ripoffs in the industry. Download my report, Classic Gold Scams and How to Avoid Getting Ripped Off, for free at goldscams.com. This report tells you everything you need to know about how to avoid losing thousands of dollars with scam gold dealers. It even tells you how to tell if a salesman is lying to you on the phone. This is a must-read for anyone considering a gold or silver investment. Download this free report today at goldscams.com. That's goldscams.com.